What happens when a global economic powerhouse like China announces a massive sovereign bond issue to stimulate its struggling economy? Let's unravel the implications. In a recent move, China has announced a sovereign bond issue worth 1 trillion Chinese yuan, equivalent to approximately 136.66 billion US dollars. This is no ordinary fiscal maneuver, but part of a larger economic stimulus package designed to give a much-needed boost to China's economy. The purpose behind this bold move is twofold. Firstly, it seeks to rebuild areas ravaged by disasters and improve the infrastructure for disaster relief. In the face of adversity, China is not only rebuilding, but also future-proofing its territories against potential calamities. Secondly, this stimulus package is sector-oriented. It is aimed at benefiting industries that Beijing sees as the new drivers of their economy. This strategic focus on specific sectors is in line with China's vision to replace old economic drivers with new ones, thereby laying the groundwork for sustainable growth. To further ensure a steady investment flow and expanded domestic demand, a bill has been passed allowing local governments to front-load part of their 2024 bond quotas. This move is expected to keep the momentum going and fuel domestic consumption. But as the news broke, the stock market's reaction was a roller coaster ride. Initial enthusiasm led to a rally, but gains were later pared down. This fluctuating response has sparked a larger conversation about China's growth momentum in the coming year. As we scrutinize the figures and forecasts for 2024, we need to be mindful of the accuracy of reported GDP figures. The question remains, is this stimulus a mere band-aid for a struggling economy, or a well-planned strategy for long-term economic stability and growth? As the stock market reacts to this stimulus, it raises questions about the growth momentum in 2024 and the accuracy of reported GDP figures. 2021 has been a tumultuous year for the global bond market. Let's delve into the significant shifts that have occurred. Broadly speaking, two key factors have been at play in these changes: rising inflation and central banks unwinding their COVID-19 stimulus measures. Firstly, let's discuss the impact of inflation. Inflation, the general increase in prices and fall in the purchasing value of money, has been on the rise, causing significant movement in the bond market. Investors seeking protection against this rising inflation turn to inflation-linked bonds. These bonds, whose principal is adjusted by the consumer price index, became exceptionally popular. Moving on to central banks, several have begun unwinding their COVID-19 stimulus measures. This unwinding has led to notable shifts in bond yields and returns. One standout example is the United States. The US 10-year Treasury yields experienced their most significant annual rise since 2013. Despite this, US bond returns were down by 3%, making Treasuries one of the worst-performing major bond markets. Across the Atlantic, the European Union made its mark, becoming a major borrower. The EU sold debt worth 140 billion euros, making a substantial dent in the global bond market. Furthermore, the EU issued the world's largest green bond, a type of fixed-income instrument that is specifically earmarked to raise money for climate and environmental projects. Meanwhile, in Italy, bond yields had their second biggest annual rise since the 2011 euro debt crisis. This rise came as the European Central Bank reduced its bond-buying stimulus. But it wasn't all doom and gloom. Junk bonds, those with a lower credit rating and higher risk, performed surprisingly well. In both the US and euro markets, these bonds yielded returns of nearly 10%, proving once again that greater risks can lead to greater rewards. As the bond market continues to adapt to global economic changes, the performance of junk bonds and inflation-linked bonds has stood out, offering intriguing investment avenues. The global chip industry is at a critical juncture, with tensions between the US and China potentially slowing its growth. Let's explore the implications. We find ourselves in a world where technology is not just a tool, but a determinant of power. The intricate dance between the United States and China, two of the world's largest economies, has made the global chip industry an arena of contention. It's no longer just about who can produce the most advanced chips, but also about who controls the technology that powers them. The founder of the world's largest chipmaker has expressed concerns over the tensions between the two nations. The fear is that these conflicts could slow down the progress of the global chip industry, a sector that's been the backbone of technological advancement for decades. The US, home to tech giants and innovative startups, has been a leader in chip technology. China, on the other hand, is striving to reduce its dependence on foreign technology and develop its own semiconductor industry. This tug-of-war has led to a technological Cold War, where both nations are battling for supremacy, not just on land, but in the world of microprocessors and semiconductors. But what does this mean for the global chip industry? Well, it's a double-edged sword. On one side, competition can spur innovation, pushing companies to develop faster, more efficient chips. On the other side, the escalating tensions could lead to trade restrictions and tariffs, which could hamper the industry's growth. Moreover, the chip industry's interconnected nature means that any disruption can have a ripple effect, potentially impacting everything from your smartphone to your car. It is a delicate balance that needs to be maintained to ensure that the engine of technological progress keeps running smoothly. As the tech Cold War escalates, the global chip industry stands on shaky ground, with potential implications for economies worldwide.